Okay, let's go a bit deeper in price action and talk a bit about boxes or ranges and channels. So as you probably know, markets have two phases. So if you see a market going like this, then it goes something like this. Okay, so the markets are either trending, as you can see in these legs right here, or ranging. The drawing that I did here isn't quite close to reality because markets are mostly ranging and they are trending quite a small percent of the time, but this is important for me to emphasize my next point. So in this lecture we are going to talk about boxes or ranges and how they can help you make better decisions in trading, and also channels. First of all, how to identify a range. So let's say that we have a nice uptrend right here. Price goes up, makes a smaller low here, goes up, and all of a sudden price drops below the last low. Okay, so if you see this in an uptrend, this will consist of your first clue that a range may be forming right here. Usually after this, the price either makes an equal high, so kind of a double top formation. So this would be one case. But the other case would be, so let's say we're here, this was the high, price makes a even lower high followed by an equal bottom. So basically if you spot this in a trend, then you are most likely going to find yourself in a ranging market. Okay, how do we use this in our advantage? First of all, if you are aggressive enough and this is your style, you can easily, once you identify two tops and two bottoms, you can place pending entries at the tops and at the bottoms, with the main purpose being that you take a sell here, a buy here, a sell here, and so on, up until you will have a losing position, because markets won't stay ranging forever and will break the range with some impulse. Note that the longer the range, the stronger the impulse will be. What is the purpose of this lecture mostly? I don't want you to trade this. If you want, again, it's up to you. But the purpose of this lesson is to learn how to identify when a trend is stopping. So again, if you see that a local low has been broken in an uptrend and the next push high isn't higher than the previous high, then these are the two clues that will confirm in 85% of the cases that you will have a range on your hand. Now let's go in real market conditions, because price, as you probably know, doesn't look like this, and spot some ranges there. Okay, for this example, I want you to disregard the indicators, just look at the price action. So we have a nice impulse to the upside, a bit of a slowdown here, impulse, slowdown, impulse, and let's see what will happen next. Okay, so as you can see, this local low has been broken by this candle. So this is your first clue that you may be inside of a range here. The next clue would be if this high holds or if this high will be broken. So let's see what happens next. Okay, so as you can see, the high didn't hold, so the price managed to create an even lower high right here. So now the price didn't push down as well. As you can see, we got rejected from here. So if we get rejections from both parts, mostly this is a sign of a range to come in this area. So you can already market something along these lines, and let's see if we can get further confirmation, but I think you guys got the point. Okay, so price tapped the top of the range. As you can see, huge fake out outside of the range. Now price is back inside this range. So again, as a recap for boxes or ranges, what you're basically looking for is price acting unusual to say the least. So again, if you have, in case of an uptrend, if you have the local low broken, that's the first sign. And then if the price doesn't manage to push and create a higher high, that's your second sign that you may find yourself inside of a range. Okay, now let's talk about some channels. Okay, so channels represent portions of price action when price is ascending and correcting without significant impulse, but the market direction stays the same. So this would be an ascending channel. Again, same thing applies to a descending channel. Again, we don't see huge legs to our direction, we just see small legs, but we are still creating higher highs and higher lows in case of an uptrend, and lower lows and lower highs in terms of a downtrend. These are easy to spot on the markets. And how are we going to use them? Well, basically, as a rule of thumb, with small exceptions, if you see an ascending channel, the likelihood of it breaking to the downside is greater than it continuing with an impulse to the upside. Same applies to a descending channel. Most likely it will break with an impulse in the opposite direction. Again, the longer the channel, the bigger the impulse will be. The logic behind this is that basically market is looking for liquidity, so it's continuously tapping into stop losses. So if the market is nearing a top here, let's say we have this sort of formation right here. So the market is nearing this top. And what's basically doing, it's stop loss hunting. So some people have stop losses here, some people have stop losses here, some people a bit higher, some people a bit higher. Thing is, the market wants to take all this liquidity out before plunging or before continuing in the current direction. So I hope I was clear with that. Thing is, how we trade these channels, basically we either wait for a breakout of the channel and then re-enter in the direction of the break, or we just spot them as general market structure so that we can have a clear ability to forecast what will happen to the market in the near future. Again, ascending channel mostly means break to the downside, descending channel mostly means break to the upside. Now let's go in real market and try to identify some channels. Okay, again, disregard the indicators, we're only looking at candles, and let's look at this formation. As you can see, this is a nice and tidy upward channel. Again, draw the trend line so that most of the wicks, most of the candles touch it, and to make it easier on yourself, just copy that trend line and paste it above. And now we have our channel, and let's see how it holds. And as you can see, identifying it, it holds perfectly. Again, this is an ascending channel, so what do we know about ascending channels is that the longer they are, the more impulse will be to the downside. As you can see, what the market is basically doing here, we have this high and this high. So imagine loads of sellers in this area that continuously get tapped out. So again, sorry, I'll delete this line. So stop loss here taken out, stop loss here taken out, stop loss here taken out. People are just selling based on this triple top formation. And what's the market doing? Keeping going up, gathering liquidity from all the stop losses that it's taken it out. And let's see how the channel will end. Taking some more liquidity, followed by, of course, a collapse to the downside. So yeah, I think this illustrates my what I was saying perfectly. So again, after formations such as this, if you see an ascending channel that goes beyond these highs, don't be tricked into thinking that market broke the structure to the upside, because there is no momentum. If the market were to break this structure to the upside, the momentum would be huge here. So you would have nice candles without wicks, so nice strong bullish candles in our case. But if you see something like this expect all the stop losses being taken out before the final bleed to the downside will continue. Okay, so I think I was clear with this, with the boxes and with the channels. It's very important for you to spot them in the markets, even if we are trading indicators, because they can shelter you from moves in the market that your indicators may not shelter you from. Okay, so this being said, let's go on one step forward and talk about triangles.